Hey there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, November 20th. I'm your host, Dave Keller, coming to you all this week from New York City. I'm actually recording this show a little bit earlier than normal, so apologize. I'm not getting the official close in. I'm recording this around 3:15 Eastern time because I need to head to a Bloomberg event, a CMT event, that is a CMT Association event held at the Bloomberg offices here in New York. So if you're in the New York area, make sure you go to cmtassociation.org and sign up for that one if you're involved with the CMT Association. We're actually celebrating 20 years of the CMT designation being formally approved by the SEC, which is a pretty awesome milestone. As one of my mentors, Ralph Eckenpora, would often tell us that story of sitting across the table with the SEC lawyers and arguing for the validity of technical analysis. Also, it's kind of an unusual day, and not in a good way. Thoughts and prayers for sure to my former Stock Charts colleagues and all of my Stock Charts friends based essentially mostly on the eastern side of Seattle, because that area just got hit with what's been called a bomb cyclone over the last 24 hours. It has knocked out power to most of that side of Seattle, including the Stock Charts office. So if you're noticing the Stock Charts website acting a little finicky today, that's because pretty much all the employees are without power, and the main office is without power too. So the site is functioning, but the people that would normally be there to make sure everything is going great are all struggling to just make sure they stay safe and keep their family safe as well. Again, hope everything is cleaned up. Hope I'm able to get back there safely on Friday morning, and I have been in touch with my family. They're all okay, and sort of getting through and trying to get trees out of the way of driveways and that sort of thing. It's been an unusual day for sure. Market-wise, let's get to the market discussion. Sort of an unusual day because I would argue today's the big news day of the week. Nvidia's earnings hitting after the close today. Now, Nvidia kind of popping a little bit going into earnings, and we'll see if it's able to sustain. And really, it's been more choppy than anything over the last couple weeks. We'll see if this ignites a new move to the upside. I think one of the challenges for this market is that the leading names have really not accelerated, right? Nvidia has broken out, but really has stalled out recently. Stock charts like Meta and Apple really are not breaking out above resistance. They're trading up to resistance and now sort of stalling out here. So the major averages are unable to move higher, arguably because the generals are not moving forward. And until and unless that happens, that's when things could really start to get interesting here. So given an unusual day and given the challenges facing the Stock Charts team, going to go to the backup system here. We're going to Koyfin, which is another system that I use pretty much every day. Looks like we're running here just fine. So apologies, it looks and feels a little different than what we normally talk about, but I guarantee it's a decent platform all the same, and hopefully helps us answer some of those same questions we're always trying to ask ourselves. What's happening now? Granted, again, we're recording this currently around 3:23 Eastern time, so I'm not into the official close, but best I can do is give you my perspective and observations as of this moment going into the last half hour of trading. The Dow is essentially flat for the day. We can see the S&P 500 currently trading about 0.4% lower. It's around 58.90. You can see the Russell 2000 down about 0.5%. And the NASDAQ 100, which of course includes Nvidia as one of those 100 stocks, is actually down 0.7% today. The VIX is pushing back up a bit, up about 1.4 VIX points to around 17.7. The VIX has been below 20 for quite some time. VIX below 20 means a low volatility, fairly safe environment for risk assets. VIX popping above 20 would be a bit of a danger sign, particularly coming out of this Q3 earnings season. Looking at the 11 S&P sectors, you can see as of this moment, it's currently about split 50-50, kind of a coin flip between higher and lower. Healthcare and energy, currently the top two performers here in the late afternoon of trading. On the downside, the two consumer sectors, consumer discretionary, consumer staples, kind of tied for the bottom of the list, followed by technology, all down about 0.7 to 0.8% today. I actually published an article earlier today on the Stock Charts platform. If you check that out on my blog called The Mindful Investor, we talked about sector rotation, 3 different tools to use to think about sector rotation. We talked about sector relative strength. We talked about looking at ratios, comparing sectors to one another. And we particularly looked at that ratio, the XLY versus the XLP. They're both down today, but the trend overall for the last couple of months has been the XLY, clearly outperforming the XLP by any definition, meaning things you want outperforming things you need, offense outperforming defense. And until that ratio changes direction overall, it's telling you conditions are pretty decent here. Great visualization here is just looking at the essentially 9 Morningstar style boxes. You can see mid caps, the best out of the 3, generally speaking. The worst performing areas of the market today: large cap growth, small cap value. Large cap growth, again, includes Nvidia, and other leading sort of magnificent 7 names are all kind of in that group. Mid cap growth, your best performer, up about 0.6% today, despite the down day for most of the major averages. Also want to note Bitcoin currently trading above $94,000. And so, Bitcoin, again, has accelerated after hitting resistance for months in that 70 to 74,000 range, and really 70 to 72,000 was kind of that key resistance for a while. Question was, when is it going to break above that level and push to the upside? It's definitely happened. And now we're pushing well above 90,000, which I would argue becomes kind of the new short-term line in the sand for me. 100,000 is not too far away, right? That's a big up day or two away from being broken here as early as this week. So you've certainly seen strength in Bitcoin. In cryptocurrencies, we've seen further acceleration with Bitcoin currently trading above 94,000. Real quick check on interest rates. We can see rates overall moving a little bit higher here. The U.S. is this top line here, and it's listed in the 1-year, 5-year, 10-year long bond points. You can see the long bond yields currently, and the bond market is closed by now. So this is around 4.6%. The 10-year yield around 4.4%. Looking at the commodity space down here in the lower right, and this is actually using mostly commodity futures. So you can see that gold actually up 0.6%, crude oil and Brent crude oil, which is sort of the European benchmark, both down about 0.4% today. All right, we don't have a working market carpet, I'm sad to tell you, but we do have the movers function on Koyfin, which we will now use. Looking at the stocks in the S&P 500 that have gained the most, you can see Keysight Technologies, ticker KEYS, is up about 7+%. That's pretty impressive. Also want to highlight Warner Brothers Discovery, WBD, at a time when so many charts are in kind of this primary uptrend, right? Kind of up and to the right and either breaking out or kind of stalling out here. Warner Brothers is one of those rare stocks over the last year that was actually trending downwards for quite some time, along with other media and entertainment names. And just like Disney and others have really start to improve. And a clear rotation, I would argue, from a period of distribution to a period of accumulation. Days like this tell me Warner Brothers Discovery very much in a period of accumulation. So you go, Warner Brothers Discovery, but nice to see that there are charts that are differentiated from others. Target on the right side, you can see the stocks down. And as of this moment, it's almost split 50-50 between up advancers and decliners today. And again, through around 3:30 Eastern. But you can see Target really pushing the way lower. Worst performing the S&P, that's down about 22% as of this moment on much heavier volume. This is after missing earnings. Pretty much all the big box retailers, or many of them, reporting this week. Super Microcomputer, which has had a nice bounce off of recent lows, actually giving back a lot of yesterday's gains, down about 9%. MPWR, which is Monolithic Power Systems, one of the semiconductor stocks, down about 5%. And that obviously, is closely related to Nvidia, as you can find on this particular page. Dollar stores like Dollar General and Dollar Tree also getting dinged about 3.5 to 4.5% on this particular day. Do want to remind you, by the way, if you like this sort of thinking about technical analysis, about focusing on and improving on your market awareness, using a disciplined approach to technical analysis, as we feature on this show every trading day, you may really want to check out our free behavioral investing course. I designed this course, and it's an email-based course. It'll send you a series of video, one a week, just to get you thinking, some ideas, a quick article, some homework actually in each step. But it really, I found, I designed it as a way to encourage you to think about how you think about the markets. And I encourage you to try it out. You can go to marketmisbehavior.com/free course, or just scan the coffee cup shaped QR code you see on your screen. I hope, and I pretty much will assume that through that course, at least one of those weeks is really going to resonate with you. And having talked to hundreds of people that have gone through the course already, they've mentioned something along those lines. It made them think, and they often will offer up some area of their investment process that improved a little bit. I hope you have a similar experience, and I encourage you to check that out on my website, marketmisbehavior.com. All right, let's look at the charts. And again, apologies, these are not through the close, which that's why I usually go live right after the bell, but have to record this just a little bit earlier to make sure the logistics all work out and I get where I need to be and ready to speak on a market outlook panel here in a short while. The S&P 500 currently, really stalling out. And if you look at the gap lower that we saw on Friday, that's when we gapped down to around 58.50. Here's Monday, Tuesday, now Wednesday session. The trading range from last Friday through today are almost identical. So basically, we gapped lower on Friday. And this week, we haven't gone anywhere. We've basically been chopping around this level. Now, as I mentioned, this is pretty common when you have a major news event coming up, in this case, Nvidia's earnings. I think a lot of the optimism, at least from my sense, is that a lot of the optimism here is kind of relying on companies like Nvidia, those leading companies that appear to be able to do no wrong, that these are going to continue to surprise to the upside. They're going to have a blowout earnings report. That's going to ignite a new 52-week high, an all-time high for Nvidia. That's going to basically strongly encourage the S&P 500 to break above 6,000 and continue further. A lot riding on this one. And that helps me, or that at least makes me think, what if Nvidia does not impress today? What does that do? And I would say the carnage could be fairly significant. Could be a bomb cyclone, just like was unleashed on the Seattle area weather-wise. Could be a market-related bomb cyclone, I would say, maybe unleashed on the markets if something like Nvidia disappoints here, because that's been the example of the strength in AI, the strength of growth stocks, the strength of the Mag 7. This is the example that will sort of further validate optimism in these markets. If for some reason we would sell off through the remainder of this week, 5650 to 5700, that green shaded area is where I continue to monitor. Note that the RSI is almost dead neutral at 50, again confirming that we're in a consolidation phase at the moment. Now, while the S&P 500 has been making new all-time highs in the month of November, and while the S&P 500 has sort of stalled out here over the last week or so, I can't help but reinforce the fact that a lot of breadth indicators have not been going up. And one of the key items on my bull market top checklist, which I recently reshared with my Market Misbehavior Premium members, one of those 7 items on the checklist is a proliferation in bearish divergences, and particularly with breadth indicators. Here we're looking at the S&P 500 in the top panel. We're looking at the advanced decline line for the New York Stock Exchange on the second one down in blue. Third panel down in green, the percent of stocks above their 50-day moving average. The bottom panel, the percent of S&P 500 members with a bullish point and figure chart. Look at the red lines, which track the trends and how they've changed in those indicators from the end of September to the mid-November, as of where we're at here on November 20th. The advanced decline line has been sloping lower, meaning less advancers than decliners, particularly on this move higher in November. A lot less stocks above their 50-day moving average, in fact, from around 85% to 55% just over the last 6 weeks, which tells you about 30% of the S&P have broken their own 50-day moving average, even though the S&P has not. About 20% of the S&P 500 members have broken down below or have broken down enough to generate a sell signal on their point and figure chart. So we're seeing distribution that is currently not being reflected in the major averages. And I would argue that is certainly a cause for concern. Here's just in a little more detail, the advanced decline lines on 4 different what we call cap tiers. So in the top, we have the advanced decline line for the New York Stock Exchange. You can see that made a lower high in November, even though the S&P, of course, made a higher high. We can see most of these actually went down a little bit. The S&P's advanced decline line also did not make a new high so far in November. Most of these, 3 out of the 4, have actually broken below their 50-day moving averages here in the last week. So again, I think we're seeing breadth deterioration that is not necessarily being reflected in the major averages, but is a cause for concern. This is the Hindenburg Omen. I shared this chart yesterday, but I did want to point out, because I got a question about it. I would agree the data is not updated yet, and I think this is unfortunately related to the stock charts office getting knocked out here by weather. So again, hopefully they're back up and running safely very, very soon. But just to confirm, given the new highs and new lows, and we did have at least 2.5% of the NYSE members making new highs and new lows yesterday, that completes an initial Hindenburg Omen signal. So I would say the initial signal has been fired, which means between now and mid-December, we would need a second signal. And let me tell you what, If we would get that sort of double signal in the month of December, then all of a sudden 2024 looks even more like 2021. The last time we've gotten that double Hindenburg Omen confirming a major top is likely was in December of 2021, right? And that was after 2021, which from a technical perspective has been in many ways almost identical to 2024, a fairly consistent and persistent uptrend, minimal drawdowns, right? So you had a 10% pullback at max, but very, very few, only 3 or 4 in the entire 12 months. And at the end of 2021, we started to get these major divergences, which signaled that the first quarter of 2022 was probably going to be pretty painful. Ended up being about 10 months of pain going into the October 22 low. And all of a sudden, 2024 from a technical perspective and a breadth perspective looking even more like 2021, which tells me be ready for a 2022 and think about what signals would confirm that that is starting to play out. As I mentioned, Bitcoin pushing above 94,000 for the first time in history today. You can see that the primary uptrend is up, and really after breaking above 74,000 earlier this month, that really clears the way to go to 100,000, if not further. Overall, we do own Bitcoin in our own accounts, and overall, I would say the primary uptrend is there. Now you're starting to get a very overextended sign, which means you start to look for the RSI to get back below the overbought region and break below 70, which may not signal a huge top, might not signal the top, most likely signals a top. So if you're looking for a tactical pullback, that's, excuse me, one of the things that I would definitely be looking for. All eyes on Nvidia. Nvidia is currently down 1.3% here around 3:35 Eastern time. The bearish momentum divergence of higher highs in price and weaker momentum stand out to me. The higher highs and higher lows, which we've experienced over the last couple of months, also stand out to me. I think of a chart like this as bullish, as innocent until proven guilty, as bullish until proven bearish. So overall, I would say the primary trend is up until and unless we break below 130. And if we get a valid close below 130 after earnings tonight and into the rest of this week, I think Nvidia becomes a very dangerous chart with broad implications for risk-off scenario going into the beginning of next year. If they beat, and if we push above 150 here on an adjusted basis, boy, the sky's the limit on the biggest stock traded in the U.S. here. All right, Apple and Meta. Again, I want to say that outside of Nvidia and with some of the other Mag 7 stocks, quite a bit below previous highs, Apple and Meta are probably the two most important charts besides Nvidia, in my opinion, because these are two charts that have stalled out. In the top half of the screen, you see Apple, which has stalled out just above $235 a share since July. You can see Meta, which has stalled out around $600 a share since early October. At some point, those stocks finally break out above those previous all-time highs and make a new high. I think that is the most bullish sign you could find. Our leading names, the growth stocks, the Magnificent Seven types, following through to the upside. Unless that happens, I don't see significant upside for the S&P above 6,000 anytime soon, right? It needs the generals leading the way higher. And as we can see from the weakening breadth conditions, the infantry is actually already struggling, which is kind of the problem. TJX, kind of a similar chart to Meta and Apple. In this case, we've stalled out around $120 a share. We recently pushed above there, but have chopped around below. TJX actually reported earnings this morning, I believe, before the open. It's up about 1/3%. I'd love to see a push to a new high, get above that 122 level, and follow through. In our webcast earlier this week, we talked about the 3 steps to every technical pattern: the setup, the trigger, and the follow through. So make sure you wait for that confirmation, sort of an additional move on the upside to confirm that the breakout is true. Not everything is looking so good today. And you can see the target is actually gapped down. It's currently trading around 21.4% below Tuesday's close. That drop actually takes us below the August low and indeed makes a new low for the year 2024 on an adjusted basis. Here's the problem with TJX. The deterioration in momentum has been pretty clear for a while because on rallies, the RSI has stalled out around 60. So it's not really looking like a bullish trend anymore. Today's gap lower really makes a new primary trend to the downside, most likely. Anytime you have a gap like this, I'm always very keen to see what happens tomorrow. One of two things is probably going to happen. Either, number one, Investors see TGT target as a fantastic bargain. They're thrilled to buy in on a great company at a deep discount from basically a 20% off coupon on the stock, and the stock immediately starts to rally back above 130, which would be the lower end of that price gap and also the August low. Or there's additional sellers. If people are so scared out of the stock by an earnings miss today that they say they don't want to touch it, even at a 20% discount, that does not bode well for the broader markets as a whole. Now, it's not all bad, though. At the same time, I'm refreshed to learn that charts like ISRG are still out there. ISRG, Intuitive Surgical, is a medical equipment name making new 52-week highs this month. You can see that the momentum is strong but not excessive. You can see that the relative strength continues to trend higher. We should be so lucky to own portfolios of charts that look kind of like this. Price above 2 upward sloping moving averages, RSI strong but not excessive, relative strength going up. That's the kind of chart that I love to look for and build a portfolio around. I'm also not too disappointed to find inflection points and to find stocks that have rotated from a period of distribution to a period of accumulation. I think a textbook on technical analysis should include the chart of WBD to show what a distribution phase looks like for most of 2023 and the first really half of 2024, a consolidation phase where momentum is sideways, relative strength is sideways, the trend is enclosed in a rectangle shape, and then all of a sudden you start to break above moving averages, break to new highs, improve momentum, improve relative strength. All those things have accelerated to the upside in the month of November. I would argue WBD, now in a primary uptrend, should be considered innocent until proven guilty. Can't take questions. I had to record this a little earlier today. I appreciate you hanging with me this week. I'm kind of whipping the entire schedule all around, but I am trying to get you a quick market update every day, as close to the close as I can. So this was the best I can do. Thanks so much for supporting me and Market Misbehavior. Thanks for all your thoughtful questions. If you're watching this on a replay, make sure that you put a question wherever you're watching it. And I would love to review your questions, hopefully answer one of them in our mailbag episode, which will be Friday of this week. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, everyone.